If you only have $1,000, this may be the turning point of your entire financial life, if you know exactly what to do next. Investing your first $1,000 is not about the money itself. It's about building the discipline and mindset that will shape your financial life. $1,000 is the moment when things stop being theoretical and become real. The key is to avoid paralysis. Don't overthink, but don't act blindly either. Start by defining objectives, safety, growth, or long-term wealth. Then choose a simple, diversified strategy to reduce early mistakes. Low-cost index funds are powerful because they let beginners access broad market exposure with low risk. Another option is allocating a small portion to high-yield savings or short-term bonds to maintain liquidity. The secret is developing the habit of paying yourself first. With $1,000 invested correctly, you build a foundation that grows, compounds, and prepares you for larger, bolder financial decisions ahead. Delinquency rates in the U.S. have surged in recent years, revealing a dangerous pattern. People are spending more than they earn and relying on credit to survive. When payments begin to slip, it creates a chain reaction that affects credit scores, interest rates, and future opportunities. Many Americans now face rising expenses, stagnant wages, and high-interest debt, pushing them into a cycle where even minimum payments become overwhelming. Understanding this environment matters because it shapes the financial risks you face. The lesson is clear. Debt is not just a personal issue. It's a systemic trap. When delinquency rises, lenders tighten conditions, assets fluctuate, and consumers lose confidence. Protect yourself by building a safety margin, an emergency fund, controlled spending, and strategic investments. Your goal is not to avoid risk but to be positioned above those drowning in it. Credit cards promise convenience, but they are engineered to keep you in debt. The true danger isn't the card, it's the psychology behind it. Credit makes you feel richer than you are, encouraging purchases you would never make with cash. Interest rates in the U.S. routinely exceed 20 to 30%, meaning any unpaid balance grows faster than most investments. Even responsible users face hidden traps. Late fees, dynamic interest, utilization ratios, and credit score impact. A single mistake can take months to undo. Credit cards are tools, not extensions of income. The smartest strategy is to treat them like a loaded weapon, useful, precise, and dangerous when mishandled. If you want to build wealth, you must master control over your spending impulses. The goal is simple. Use credit cards for points and protection, but never let them own you. Paying off debt is not just a financial action. It's a psychological liberation. Begin by mapping every debt, balance, interest rate, and minimum payment. This gives you visibility and control. Then choose a strategy. The avalanche method targets high-interest debt first, saving you money long-term, while the snowball method prioritizes small balances for motivational wins. Both work as long as you stay consistent. Redirect every extra dollar toward your principal, bonuses, side income, tax refunds, everything. Negotiate with lenders. Many will reduce interest or restructure plans if you show commitment. Cut unnecessary expenses temporarily and convert that margin into debt elimination fuel. The goal isn't just to pay off debt. It's to break the behavioral patterns that created it. Freedom begins when interest stops consuming your future earnings. Debt may be common, but it should never be normal. Normalizing debt means normalizing financial dependency. Saving money starts with rejecting this mindset. Saving is not about deprivation. It's about freedom and optionality. Start by automating your savings. Set a fixed amount that transfers immediately after receiving your income. Treat savings like a bill you owe to your future self. Cut emotional spending by identifying your triggers: stress, boredom, social pressure. Build a strategy for essential versus non-essential expenses. Even small savings matter. Consistency beats intensity. With time, your saved money becomes a shield against emergencies and a gateway to investments. When you save intentionally, you reverse the cycle of debt and reclaim control over your financial path. Fixed income investments in the U.S. have become increasingly attractive due to rising interest rates and economic uncertainty. Treasury bills, high-yield savings, and certificates of deposit offer stability and predictable returns, something the volatile market can't always provide. But fixed income is not about getting rich. It's about preserving capital and reducing risk. It acts as the backbone of a balanced portfolio. For beginners and cautious investors, fixed income provides safety while your confidence grows. For experienced investors, it serves as a hedge during market downturns. The question is not whether fixed income is worth it, it's how much of your portfolio should be allocated to it based on your risk tolerance. The right balance creates resilience and prevents emotional decisions during market turbulence. Investing can become an addiction, but unlike harmful addictions, this one can transform your life if managed correctly. The excitement of watching numbers grow can push people to invest impulsively. But real wealth is built with discipline, not adrenaline. Saving must come before investing. Without savings, investments become fragile, and any emergency forces you to liquidate at the worst moment. Build a routine, automate your savings, set long-term goals, and treat investing like a responsibility, not entertainment. Learn to delay gratification. The more you save, the stronger your financial foundation and the greater your ability to invest strategically. Healthy investment addiction means consistently prioritizing your future over immediate impulses, and that mindset is priceless. Variable income, stocks, ETFs, REITs, and other market assets offers the greatest potential for long-term wealth but comes with real volatility. The market will challenge you emotionally. It rises slowly, crashes violently, and tests your conviction constantly. Yet historically, variable income has outperformed every other asset class when held long enough. The secret is not predicting short-term movements but embracing long-term patience. Invest consistently, avoid timing the market, and use diversification to reduce risk. Beginners should start small, focusing on broad market ETFs or blue-chip companies. Over time, your investments compound, and the ups and downs become irrelevant compared to the overall upward trajectory. Yes, it's worth it, but only if you commit for the long run. Choosing good companies requires understanding how they make money, how they grow, and how they survive economic downturns. Start with fundamentals: revenue growth, profit margins, debt levels, and competitive advantages. A strong company creates value consistently and adapts to market changes. Look for businesses with solid leadership, predictable earnings, and products people want regardless of the economy. Study their long-term vision and whether they reinvest intelligently. Avoid being seduced by hype. Profit comes from discipline, not speculation. When you choose companies with durable strategies, your returns come from real performance rather than temporary momentum. Think like an owner, not a gambler. Good companies make money even when you sleep. Analyzing a stock like BBAS3 requires a structured approach. Begin with financial statements: revenue, net income, return on equity, and efficiency ratios. BBAS3, as a major bank, depends on credit operations, interest spreads, and risk management. Examine its loan portfolio quality, delinquency rates, and provisions for losses. Assess its dividend history, payout ratio, and long-term sustainability. Compare its valuation metrics PE, PB, and ROE with industry competitors. Study external factors such as economic cycles, regulatory changes, and interest rate policies. A strong bank stock shows resilience during crises and stability in cash generation. The goal is not to predict short-term price swings, but to understand whether the company can deliver consistent value over time. Building a stock portfolio requires clarity, discipline, and diversification. Start by defining your risk profile: conservative, moderate, or aggressive. Balance your assets between fixed income, blue-chip stocks, growth stocks, and ETFs. Diversification prevents one bad investment from destroying your progress. Allocate more to stable companies and less to speculative plays. Reinvest dividends to accelerate compounding. Review your portfolio quarterly to rebalance and remove underperformers. Avoid emotional decisions. Buying at peaks or selling during crashes destroys long-term gains. A well-built portfolio reflects your goals, not market noise. Over time, the consistency of your strategy becomes more important than the size of your initial investment. ETFs are one of the most powerful tools for investors seeking simplicity, diversification, and long-term growth. By buying a single ETF, you gain exposure to hundreds or thousands of companies, reducing risk instantly. Their low fees and automated diversification make them superior to most actively managed funds. ETFs remove the pressure of picking individual stocks and help you follow the market's natural long-term upward trend. For beginners, they provide an easy entry point. For experts, they offer efficient ways to hedge or expand exposure. Yes, ETFs are worth it because they combine safety, growth, and convenience. If you want to build wealth without stress, ETFs are essential in your strategy.